The current live price for Hanesbrands Inc., ticker symbol HBI, is sitting at $6.47 as of the close on Friday, November 28, 2025. The stock saw a downward shift during the last trading session, sliding by 1.82% or roughly 12 cents, with significant volume as the market digested the latest institutional shifts. Since the markets are currently closed on this Sunday, these figures represent the most actionable data available right now, setting the stage for what promises to be a volatile opening bell tomorrow. Most investors look at Hanesbrands right now and see a company in a holding pattern, a legacy apparel giant simply waiting for its acquisition by Gildan Activewear to finalize. The expectation is that the stock is dead money, effectively pegged to the buyout price, with nothing left to do but wait for the regulators to sign off. That is the safe, comfortable narrative. The reality, however, is far more chaotic and arguably more dangerous. What we are witnessing right now isn't just a waiting game. It is a massive technical dislocation caused by the company's removal from the Russell 3000 and Russell 2000 growth indexes, which occurred just 2 days ago. This exclusion has triggered a forced selling event where index tracking funds, those passive investment vehicles that mindlessly buy whatever is in the basket, are compelled to dump millions of shares regardless of the underlying fundamental value or the merger prospects. This creates a disconnect, a temporary distortion where the price action is driven not by humans making rational decisions about the Gildan deal, but by algorithms executing mandatory liquidation orders. While the average retail investor using Robinhood or SoFi Invest might look at the red chart and assume the deal is in trouble, the deeper truth is that this is a structural market mechanics issue, not necessarily a business failure. This tension between the deal arbitrage narrative and the index deletion crash is where the real story lies today. When you look at the chart from Friday, you see that heavy volume, over 110 million shares traded, which is significantly higher than the average. This confirms the capitulation of the passive funds. But to understand why this matters, we have to look at the broader context of what Hanesbrands has been doing for the last 18 months. It has been a period of aggressive, almost ruthless restructuring. The expectation was that Hanesbrands would simply fade away as a declining mall brand. The reality is that management has been surgically carving up the company to save it. The biggest move, of course, was the sale of the Champion brand to Authentic Brands Group, which was completed late last year. That sale was the first domino. It stripped Hanesbrands of its global athletic wear identity and forced it to retreat to its core: innerwear, underwear, socks, and basics. This is a much less sexy business than streetwear, but it is cash flow positive and stable, or at least it is supposed to be. Now, let's talk about the elephant in the room, the Gildan Activewear acquisition. Announced in August 2025, this deal is the end game for Hanesbrands. Gildan, the Canadian apparel giant, known for its dominance in the printwear market, think of all those blank t-shirts used for concert merch, made a move to acquire Hanesbrands to consolidate the North American basics market. On paper, it makes perfect sense. Synergies, scale, supply chain dominance. But the market is clearly nervous. The stock is trading at $6.47, and while the deal was valued at roughly $2.2 billion, the spread between the current price and the implied deal value, often fluctuating based on stock components or debt assumptions, indicates that Wall Street is pricing in a real risk of antitrust intervention. If you are sitting there holding Apple stock or Tesla stock, you are used to volatility driven by product launches or tweets. Here, the volatility is driven by lawyers and bureaucrats. The FTC has been incredibly aggressive lately, and the idea of merging two of the biggest underwear manufacturers in North America is exactly the kind of thing that rings alarm bells in Washington. If the deal goes through, today's buyers get a modest return. If the deal is blocked, Hanesbrands is left alone without Champion, carrying a still substantial debt load, and having just been kicked out of the Russell indexes. That is the cliff edge we're walking on. The recent Q3 earnings report, released earlier this month on November 6, 2025, gave us a glimpse of what Hanesbrands looks like as a standalone entity if the deal fails. The numbers were complicated. Earnings per share came in at 76 cents, which looks massive on the surface, but it was heavily inflated by a discrete tax benefit. If you strip that away, the adjusted numbers show a company that is still fighting for margin stability. Net sales were down about 1% year over year. This is the common ground investors share, the belief that inflation and consumer weakness are hurting apparel. And they're right. You have families choosing between groceries and new packs of socks, and often the socks can wait. However, the contrarian take here is that Hanesbrands has actually improved its operational efficiency significantly. They've managed to expand operating margins despite the sales dip, thanks largely to the cost-cutting measures initiated before the Gildan talks began. They're not just bleeding out, they're getting leaner. This brings us to the mechanics of the trade right now. If you're using platforms like Interactive Brokers or Fidelity, you might be seeing high short interest or weird options activity. That's the arbitrage community positioning themselves. Merger arbitrage is a strategy usually reserved for hedge funds, but with the democratization of trading via apps like Robinhood and Webull, retail traders are increasingly stepping into these binary outcome trades. The removal from the Russell index adds a layer of complexity because it artificially depresses the price. If you believe the Gildan deal will close, the index dumping is a gift. It allows you to buy the buyout target at a discount caused by non-fundamental selling. It's like buying a house for cheap just because the current owner is forced to move out by the weekend. But if you're wrong and the deal breaks, the floor for this stock could be much lower, potentially in the $3 or $4 range where it traded during the worst of the uncertainty last year. Let's pause for a second and look at the company itself. Hanesbrands, founded over a century ago, is an American institution. It owns brands like Hanes, Maidenform, and Bali. For decades, it was a staple of the American wardrobe. But the retail landscape shifted. The rise of fast fashion, the decline of the department store, Hanes's biggest channel, and the explosion of direct-to-consumer brands created a perfect storm. The company responded by loading up on debt to buy growth, a strategy that backfired when interest rates spiked. That's why the Champion sale was so critical. By selling Champion, they cleared a chunk of that debt, but they also sold their only real growth engine. Now, Hanesbrands is purely a value and yield play, though dividends are suspended. It's a utility company for clothing. People will always need underwear, but they won't necessarily line up around the block for it. The business model now relies entirely on supply chain execution, getting cotton from the field to the shelf cheaper than anyone else. Speaking of cotton, we have to discuss the macro environment. Commodity costs have been volatile. Cotton futures have fluctuated wildly in 2024 and 2025 due to climate anomalies in major growing regions. Hanesbrands is massively sensitive to this. When cotton spikes, their margins get crushed because they can't easily pass those costs on to a consumer who's already balking at high prices at Walmart or Target. Conversely, when cotton crashes, they win big, but there's a lag time of roughly 6 to 9 months for those savings to hit the income statement. Right now, we're in a period where input costs have stabilized, which is helping them, but freight and labor costs remain stubbornly high. This is the unsexy part of the analysis that you won't hear on the hype channels, but it matters. If the Gildan deal falls apart, Hanesbrands' survival will depend entirely on the price of a pound of cotton and the cost of a shipping container from Asia. I want to hear from you guys on this. It's a binary bet at this point. Comment below, do you think the government will allow the Gildan acquisition to proceed, or are we looking at a blocked deal and a stock crash? I really want to see the sentiment on this because it seems split right down the middle. Now, let's look at the technicals on the chart. If you pull up the daily time frame on your Fidelity trading platform, or even on a simple interface like SoFi Invest, you'll see a death cross pattern that formed earlier this year, followed by a consolidation range. The price has been chopping between $6 and $7 for months, acting like a compressed spring. The drop to $6.47 on Friday pushed the stock below its 50-day moving average, a bearish signal for technical traders. The RSI is hovering in oversold territory due to the index exclusion selling. Typically, when a stock is dumped from an index, you see a V-shaped recovery in the days following the rebalancing, as the selling pressure evaporates and value buyers step in. So Monday and Tuesday of this coming week are critical. If the stock reclaims the $6.60 level, it suggests the index selling is done. If it languishes here or drops further, it implies that the market is starting to price in a higher probability of the deal breaking. One interesting angle to